firms may choose to borrow the currency in which interest rate is lower. Similarly, if you need currency, you can come with your country's dealer. You can buy a dollar. What if the dollar in your country is very expensive? You can ask the bank or dealer in US to loan you some currency, and after 3 months or 90 months and 90 days, you're gonna repay that one. And what is the motive? Where you can find it cheaper. Of course, nobody is giving you for free. Everybody, whether you whether you take loan from home country or whether from the foreign country, you have to pay interest. So if you can save interest by getting loan from foreign country in foreign currency, then of course you will prefer that one. And also, you want to borrow the currency which is expected to depreciate. That is very important. These two make sense, but this one is a little bit tricky. So remember, and if you are here, so if your analysis is, you have analyst and your analysis suggests that the yuan after 4 months going to depreciate, right? Which means US dollar is going to appreciate. Exchange rate of yuan is going down, mean exchange rate of US dollar will appreciate, right? So before 4 months, you take loan from China. So when you take loan from China, Chinese yuan converted into dollar, and you receive dollar here. You can use the dollar. And what happened after 4 months? Yuan exchange rate decreases. When you pay back, you need less dollar to convert into yuan. So you will have some savings due to foreign currency depreciation. You will receive the same yuan, but less dollars are needed to convert into those yuan. For example, your interest is 10,000 yuan, but the person will receive 10,000. But previously it needs, for example, $700 to convert into 10,000 yuan. But now due to depreciation, it needs $600 to convert into 10,000 yuan, right? So you will have a saving of $100. So look at that. You didn't do anything. Interest rate is same in both countries. But what happened due to the exchange rate is decreasing in China after 3 months. So after 3 months, when you pay back, you have to convert less dollars. You will save some money. So why you go to international money market? Number one, to borrow funds to pay for imports, right? First, then you want to buy in a currency which offers you lower interest rate, plus you want to buy loan or borrow loan from that country whose currency is expected mean in future, when you are paying back the interest and principal, the currency is going to be depreciated. Now, origins and developments. So before we have European money market, we have Asian market. So now they have developed, extensively. So let's just talk about some overview here. So we have European money market, which means dollar deposited in banks in Europe and other countries are called euro dollars or euro currency. Remember this one. Euro dollar means foreign dollars that are not in US. All the dollars that are not in US, these are outside US, we call this euro dollars. So that doesn't mean that if you want to have a loan in dollars, you have to go to US. No, you can ask other countries to give you dollar. But if you ask other countries to give you dollar, that dollar is called euro dollar, which means the dollar you acquired is not from US, US banks or US country or US investor. It is from other person who has the dollars or other company or other banks or outside America. The origins of the European money market can be traced from euro currency market developing in 1960s and 1970s. Since they have developed so fast, so many countries they have large reserves of dollars, so they are also lending the dollars and receiving interest in dollars. So you can also get the loan in dollars from European countries as well. But which short-term loans or long-term loan whatsoever from European money. Asian money market. So Asian money market, which is centered Hong Kong and Singapore. But right now, due to the taking back of Hong Kong or merging it with China, now Hong Kong is now shifting its all the money and market, all the exchange markets in Shanghai and Shenzhen. So it takes a slow process, but in future there is no Hong Kong market, there is China market. So they are linking each other. Shanghai, Shenzhen, and Hong Kong market will become a one China market. So, but right now still we cannot deny its existence, Hong Kong. So Asian market consists of Singapore and Hong Kong. So you can also ask loan from there. But if you ask loan from there, we call this Asian dollar market, which means they are not lending you in yuan, they are not lending you in HK dollar, Hong Kong dollar, or in Singaporean dollar. They will be lending you US dollar, and we call this Asian dollar, right? Euro dollar means that you are asking loan from European countries, but in dollars. Asian dollar means you are asking loan from Asian countries, but in dollars. So money market interest rate among currencies. Many money market interest rate in a particular country are dependent on the demand for short-term funds by the borrowers and relative supply of the available funds provided by the savers. So simple. How interest rate is going to be determined? So look at that. See, 1 year interest rates, 1 year interest rate in different countries. See, Japan close to 0, United States close to 1, United Kingdom close to 2, Germany 2, Australia 3, Brazil is like 9. So short-term interest rate depends on demand and supply. So why in Brazil short-term interest rate is high? You can say that we are using money for only less than 1 year. Interest rate should be lower. Why? Because we are using money for less than 1 year. So 20-year interest rate must be high. Why? Because money is going to be stuck for 20 years. But 20 years rate is going to be decreased. Why? Because no one wants to provide you loan for 20 years, but everybody wants to provide you loan for 1 year. So that depends on number of short-term demand and number of short-term funds supply and demand. So here we go. So if in a country demand for short-term funds are higher, then interest for short-term will be also higher. If in a country demand for short-term funds are lower, then its interest rate for short-term funds are also, then interest rate for short-term funds are also lower. So money market rates vary due to differences in interaction of total supply of short-term funds available in a specific country versus total demand for short-term funds by borrowers in that country. So remember, if you are MNCs and if you are a big company, I hope you have your family businesses and you yourself start a business and that grows too much. You become multinational, businessman. So if you want to take loan, then you ask your finance manager to work on one stuff. That is where the short-term money supply is higher or lower. So if supply is higher, its price goes down. So money price is interest, right? So if interest is lower in that company, short-term interest rate is lower in that country, it means over there demand for short-term loans are not very high. So you go to that country and buy loan or ask loan from that country, which would be very cheaper to you. So don't go in that country where demand for short-term is higher. Why? Because an interest rate is going to be higher in that country as well. Understand, everyone? Oliver, Tiffany, Ichi, Sufyan?
Yes, understood.
Yes, sir.
Good. So the comparison I already told you here. See? So where the short-term interest rate are lower and where the demand is high in Brazil, companies should ask short-term loan from Japan. If they ask from their home country, they have to pay a larger interest rate. So rather just go to Japan and ask. So do you think it's easy? You need government approval, you need different kind of stuff. So sometimes if you find out the opportunity, do go there. If you cannot have due to the government restriction and all those stuff, then you can exploit this opportunity. For global integration of the market interest rates, we will talk about in our next class. So up till now, what we have covered the spot market, derivative market, we have covered the money market. And in that spot market, we talk about spread. And in future and forward market, in derivative market, we covered about future, forward, and currency options, call option and put option, right? We also talk about in spot market, we also talk about the cross rates, which is how we can have benefit from cross rate by involving third currency, which is comparing foreign currency with another foreign currency and using our cross exchange rate knowledge to benefit to ourselves, right? So if you still have any question, you can also text in our WeChat group. I would be happy to answer. Okay, we are ending our discussion here and we start in our next class, the global integration of money market interest rate. Until then, take care, stay safe, bye-bye.
All right.
Bye-bye. Thank you.
Thank you, sir. Bye, sir. Thank you.
Thank you.